Morning, market chameleons. Thanks for joining the pre-market show. How are you doing, Dima?
Good morning, Will. Good morning, everybody. Thank you for joining us.
Did you get enough sleep after last night's extra long webinar on long call option screener?
Yeah, actually, I felt, except, you know what? I don't know about you. Maybe I got to cut down, I think, on my coffee because, like, I wake up in the middle of the night and I feel like, is it the coffee? Like, I'll fall asleep.
Well, an
And
hour and 10-minute webinar about the long call option screener that seemed like we left, like we could do a whole nother webinar on it. We left a lot,
yeah,
still to
yeah,
talk
definitely.
about.
Well, if there are questions today on it, I'll jump to that screener. Hopefully, answer any outstanding questions, of course.
Awesome. Well, those people who are on YouTube Live, I see some new people for the first time. If you've never subscribed to the channel, make sure you subscribe. Thumbs up are always appreciated. And with that, D, and ask any questions in that chat. I will try to relay them to Dimitri. With that, do you want to get started with the disclaimer?
Yeah. So everyone, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your registered investment advisor or call your broker. They should be able to help you answer your questions, provide you with guidance. So there's the disclaimer, everyone. With that, I think we could get started here.
Cool.
So let me share my screen here. And what I wanted to do today, we'll start out with what's moving in the pre-market hours. I'm going to show a new feature we released, the post-earnings drift report. So I think we're going to get to that, just kind of lay the groundwork, just give an idea what it is and what it even means. Then we might jump to if there are questions on that call screener from yesterday, we could jump to that. If not, we'll take a look at earnings and unusual option volume. So, with that, let's begin with the pre-market report. So if you guys are joining us for the first time, these are stocks. This report is showing stocks that are actively trading in the pre-market hours. We got the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to go really quickly here to see what's moving in a pre-market in a higher market cap stock. So let's just use this filter market cap of stocks over 20 billion market cap or higher. So here we see, just really quickly, I see that 28 of them made the percentage gainers list, 10 on the percentage decliners list. Top ones, BLK, Disney. So this is BlackRock. Disney up 3.9%, and we've been talking about it a little bit. They're going to start focusing more on that streaming service, right? With creating content and streaming.
Yeah, well, we talked about it, I think, last week, and one of the large investors, I think it may have been Einhorn, recommended they actually cut their dividend and put all their excess cash into developing their streaming service. So with that, they announced, I guess it was after hours yesterday, that they are going to reorganize the organization and put a lot of resources into that project. So
yeah,
there you go.
And I think, and from, I think I was reading it maybe a year or two ago, that some of the most successful content on Netflix actually came from Disney, right? Like, I think like it's Friends. Is that like a Disney?
It may be a product. Yeah,
that was one of them. So certainly, I think they benefited anyway from the Netflix. But if they're going to compete head on, and I think maybe the aha moment was when we seen the coronavirus that when you're like Netflix did pretty well. These a lot of these companies that are doing a lot of their business online, like Amazon, Google, Facebook, they've done pretty well, but Disney has been struggling because of those theme parks, right? So they're still struggling on on those theme parks. But anyway, Disney up 3.9%. You might even take a look at it pre earnings today when I go to the post earnings drift. Apple, I think today they're going to have some event. Is that correct, Will? Talking about their new iPhone.
Yep.
So keep eye out on that. Unusual option volume yesterday was up. It was up a lot yesterday. So let's see, a lot of enthusiasm building up to that event. Let's take a look at the unfiltered report really quickly. So we have a few stocks up here, a few low market cap stocks popping today. PED up 155% on 1.6 million shares. Looks like, let me just take a look at that headline. So that looks like a takeover. MDGS, that's up 58%, trading 10.9 million shares. Let's just see what that news is. So there is some news on it. Let's just take a look at this one then really quickly as an example. MDGS, let's see what's going on in this stock. So the small cap stock, medical devices business, to close at $1.89 yesterday. This is its 52-week range, 83 cents to $5.15, trading at $3.04 in the pre-market hours. That's up almost 61%. VWAP in the pre-market, $3.23. The range in pre-market, $1.81 to $3.67 on 11 million shares trading hands. So very active. This is what the pre-market chart looks like. Longest VWAP bar, $3.44 to $3.59. If you want to read, what's behind the move, it's over here. We're not going to get into interpreting the news, but let's just take a look really quickly at its gap history. And I'm going to click here to its gap history. We're going to take a look at its biggest gap moves in the last 3 years and what it tended to do after gapping up in the morning, what happened, the rest of the day. So here we're looking 12 largest gap moves in the last 3 years. These are the dates, the press releases next to them, if the company issued a press release, any type of notes. So here we see these are the gap moves. So on average, the average of the 12 largest gap moves, 70%. We see one as high as 414%. Today, up 60% in the pre-market hours. Let's see what this stock tended to do after the open. So we see after the opening, the average move from the open to the high of the day was 13.9%. We see one of those days, the opening move, that opening price was the high of the day. The average move from the open to the low of the day was negative 20.9%. So a little bit skewed more to the downside than upside. Historically, out of the 12 largest gap moves to the upside, we see that it tended to, by the end of the day, to drift lower. So we see in at least these 12 observations, from the opening price to the closing price, it was down each time for an average loss of negative 14.2%. Keep in mind, there was news today. You should check it out just to make sure what you think is going on. Because it does seem, I don't know, I see Amazon there, so maybe there's a deal in Amazon. So take a look at it, see if that move is justified or not. But we're just looking at it from a historical price action analysis in MDGS. I'm going to close that. If there are any questions on the pre-market report, Will, let me know. If not, I'm just going to move on.
Nope, you can move on, buddy.
Okay. Let's take a look at, before we go into earnings, I'm going to I have Apple queued up here. So I'm going to just show you guys post-earnings drift. So what a post-earnings drift is that we know every quarter the companies, or just about every company, releases their earnings every quarter, right? And during that quarter, there's certainty. We know how much they earned, what their revenue grew by. The management lets us know, gives us guidance, what they're thinking about. So every quarter we get a lot of certainty. And during that certainty period, when we get that information, the price of that stock can reprice right away to a new fair value, right? Because everybody could digest that information and come up with a new fair value, let's say, by the end of the day. But of course, once that happens, the market doesn't stop, right? So it's not like the stock reprices and stays at that one price until the next earning. So what you'll see is in between those dates, in between the dates of the company releasing new information, and really the company doesn't know what it's going to earn next quarter, right? They just know up to now this is what it earned. So in between those dates, it's not like the stock just sits there at the same price and reprices on every earnings announcements. What you see is then the stock will start drifting one way or the other. And of course, a lot of it could be because of any type of economic events, on a global scale or macroeconomic industry, or a lot of times it's just people starting to build up expectations to the next quarter, right? So nobody knows for sure what's going to happen next quarter until it's released, but those expectations are starting to build in, either pessimistic or optimistic expectations. And usually you'll have some kind of a drift from that price prior to the next earnings announcement. It could go up 5%, 10%. So that's what we're looking at. What usually happens between earnings, right? Like where there's still uncertainty about what that next earnings is going to be. That's a post-earnings drift. So let's take a look over here in Apple. I'm going to go to Apple here, post-earnings drift. So we'll take a look what it's been doing since its last quarter. So over here, this is where it was the last quarter, closing price 106. So after releasing earnings, we see it beat earnings per share. It beat on the revenue. The stock was up 10.5% right after that. After releasing their earnings, there's a day to digest it. They release it after the market closed. So the next day it was up 10.5% to close at 106.26. So let's see what happened afterwards. So since its last earnings, we see that Apple right now, it's drifted up 17.1%. Right. So right now it's up 17.1% since its last earnings. So how does that compare to history? Right. So let's take a look at that. On average, in the last 12 quarters, I have this set up for the last 12 quarters. On average, Apple drifts based on the last 12 quarters, 7.4%. So it's on average up 7.4%. 67% of the time it drifted higher. 33% of the time it drifted lower. In absolute terms, up or down, it moves on average 13.8% up or down. Okay, 13.8%. That's in absolute terms. A one standard deviation move here is 10.6%. So right now we've seen most of these gains out of this 17.1 has been in actually the last couple of days. Yesterday was up 6.4%. So based on history, how far away did it drift? It's about 1.6 standard deviations, right? So right now we could tell there's more enthusiasm built into Apple. Of course, there's an event coming up today, with the new iPhone that could make a difference because it's a new product. Maybe that will launch and spur a lot more sales. Well, that's at least the anticipation with those 5G phones. So I'm just going to give you like a comparison. And really, where people play this is if once they release earnings and there's a repricing, what does it usually do afterwards? So if you're playing the post earnings drift, you could take a look. Well, what is it at on average? How does it perform between earnings? A lot of people play like the iron condors. What's the average drift from to the high, right? To the high, between now and to the high, and between now and to the low. So the average drift to the high is 14%. The average drift to the low is 9.5%. Right now we're at 17.1%. The highest drift, let's take a look, in the last 12 quarters was 33%. All right, so here we go. Like last quarter, it was up 33% in between earnings, right? From reporting from the last reported earnings right before the next reported earnings, it drifted up 33% and then beat and gained another 10%. All right, so that's where we are now. So let's compare that right now to a 1.6 move like to someone like Google. So we see Google right now, that's up 5.8% since its last reported earnings. Standard deviation move is 5.9%. So we see that's up one standard deviation. So still up to the upside, not as much as Apple, a lot more enthusiasm built into Apple. Since we mentioned Disney, let's just take a look at that. So Disney, as of yesterday's close, that was down 2.1% since its last reported earnings. Of course, they have that, those problems with the theme parks. But looking at the average drift, standard deviation 9.4, that's down 0.2 standard deviation. So that's really almost unchanged from its last earnings. So when you're looking at how far away did it move from its average, from its average move in between earnings? Because remember, we still don't have certainty until that earnings is announced. So does that make sense? Well, if there's any questions, let me know.
I think everyone's good, buddy.
Okay. I'm going to move on then from here because I wanted to touch on earnings. Let's see what's coming up on the earnings front. So we're going to take a look at earnings coming up in the next 2 weeks. Okay. I'm going to screen for stocks that on average trade at least 5,000 contracts or more. So this average daily option volume, 5,000 contracts or more. So we see here Wells Fargo, that's coming up with earnings tomorrow before the market opens. Here we see this is what the straddle is pricing in currently, the move in either direction, 4.8%. In other words, buying the call, buying the put, you need a 4.8% move, higher than 4.8% move to be profitable from the buy side. From the sell side, you need that move to be below 4.8%. So that's the implied move, 4.8%. That compares to the 4-quarter average move, the historical actual move in either direction in absolute terms of 3.9%, and a 12-quarter average move of 2.7%. So we see that straddle is 0.9% above that 4-quarter average, 2.1% above the 12-quarter average. The high move in Wells Fargo, actual move 5.4% in the last 12 quarters. UNH, that's also expected to report tomorrow before the market opens. Current straddle is pricing in a 3.5% move. That compares to a 4-quarter average move of 4.1% and a 12-quarter average move of 3.7%. So we see that's actually priced below the 4-quarter average and the 12-quarter average, with a high move on that 8.2% in the last 12 quarters. Bank of America, so a lot of banks are coming out. Bank of America expected to report tomorrow before market opens. That's expected to move 4.2%. That compares to a 4-quarter average of 3.1% and a 12-quarter average move of 2.4%. So we see, 1% over that 4-quarter average, 1.7% over the 12-quarter average, with a high move on that 7.2% in the last 12 quarters. Let's take a look at 2 more. USB, that's same thing, expecting tomorrow before the market opens. Looking at a 4% move in either direction right now implied by the options market, compared to a 4-quarter actual move of 3.7% and 12-quarter actual move of 2.5%. So we see a little bit above that 4-quarter average, 0.2%, 1.5% above that 12-quarter average move, with the high move 6.9%. United Airlines, they're waiting for a bailout, right? They're still looking at some bailout money.
I think
So-
all the airlines are waiting on bailout money.
Right. So and they've been struggling. So we see right now option straddle pricing in a 7.8% move in either direction. We see last 4 quarters, the average move was 4.8%. Last 12 quarters, the average historical actual move was 6.2% in either direction. So that's 3.1% above the 4-quarter average, 1.7% above that 12-quarter average. High move is 12.1% in the last 12 quarters. And is that American Airlines AA?
I think AAL is American Airlines. I think that may be Alcoa.
That's Alcoa. So again, that's also tomorrow after market close. Let's just do that one really quickly. So we see there, that's pricing in 7.7% move. That compares to a 4-quarter average move of 6.9%, 12-quarter average move 5.4%. So we see 0.08% above 4-quarter average, 2.3% above the 12-quarter average. High move on that in the last 12 quarters, 13.3%. So these are people who are playing the earnings moves. We're comparing the implied moves versus the historical average to see how much the current markets are overestimating or underestimating the move relative to the historical averages. What I could do right now is maybe choose one and see how the implied volatility moved after the earnings, unless you have any questions coming up.
Cool.
All right, let's take a look at Wells Fargo. So I'm going to click on Wells Fargo, and we'll do a deeper dive into the earnings analysis. So here we see over here, this is a chart. So these bars here, up and down, that represents what the options were expecting the move to be in either direction, up or down. So you see it starts at 0. So here, up or down, that was what the straddle is pricing. That compares to the one in the red, this red bar, that was the actual move after earnings. The red bar represents that the actual move was to the downside. This green bar over here represents that the actual move was to the upside. So let's just take a look at this one that I'm hovering over. We see July 14th, Wells Fargo reported earnings before market opens. The actual move was negative 4.6%. The straddle was implying a move of up or down 8.2%. So you see that straddle was overpricing that move. Let's take a look at the average. So we see here that historically in the last 12 quarters, the straddles overestimated the move 67% of the time. On average, they were predicting a move up or down 3.9% versus the actual move of 2.7%. So about a 1.2% differential between what the options were implying versus the actual move. Let's take a look at the volatility and what it did. So then what we do is let's go out. We're going to take a look at what a 30-day, an option with 30 days to trading days to maturity, what the implied volatility did in that option from the day before earnings to the day after. So these are people, if you're not just playing the move, but you're playing an implied volatility crush, right? Usually you're going to use some kind of a calendar spread where you're hedging the move, buying the near-term option, selling the longer dated option for that vega and the volatility crush. So let's take a look at what happens in a 30-day option with 30 days to maturity. So we see here that on average, the implied volatility crush day before earnings to the day after has been 15%. So the average implied volatility going into earnings was 29.5. The day after, average implied volatility is 25.1. 5 days later, the average implied volatility was 24. So it seems like it still came in a little bit more 5 days later. Right now, markets aren't open yet today. So we're looking at yesterday's closing. The implied volatility closed at 43.3 compared to the average of 30.3 2 days before earnings. We see the high of 64.6 and the low 18.7. So it is above its historical mean based on these 12 quarters, but not the highest. It's been 64.6. So that's where we are right now in the Wells Fargo WFC heading into earnings.
We have a chameleon on the chat, Mike, who is on pretty much every day. He's just asking, can you link? I don't know if it's a situation where he's not familiar with. He wants to see how the I'm assuming it's what he's saying, that the straddle, showing the straddle, how it compares actual move versus implied move, where you see that graph versus previous earnings. So I think it's, where you see, what is it? Maybe it's the actual, the implied actual earning versus what it was implying, all the earnings in a row.
Like this, right? So you mean like this chart right here? So this is showing, so these bars over here, that's showing what the straddle was implying, the move up or down. So you see here, these are the percentage moves up or down versus what the actual move did. So you could kind of see where it broke through. So over here, this is to the downside. It broke through that implied move. It was down 5.4% versus the implied move of 3.1% in either direction. So you could see by, the magnitude it broke through. Here, I don't see any to the upside, but, broke through a couple times to the downside.
Seems like was that the same stock we were looking at the other day when you showed it? I mean, it's amazing how, you look at the last three earnings, I mean, it's obviously the volatility in the market around the virus and everything else, how the last three, the implied versus actual is just incredible.
Yeah. So when we had that, I think it was probably it was at the top of the list yesterday. So probably looked at this one as well. But see these bars over here where the straddle was priced very, very rich in April, where we're in the midst probably of that, when the virus started to kick in, we started closing up the economies. So you could see how much the straddle was priced there. July, it's coming in a little bit more certainty here coming in. October 14th, you see it's not as high as the last two, but it's still, when you compare it to pre-coronavirus, still it's more rich, maybe down here, October 12th, it got close to it. But just to show you the range, you see here 4.8%, right, in either direction. That's what it's predicting right now, 4.8%. And that compares to 12 quarters, the average expectation is 3.9%. So about one, so it's probably, putting in an extra percent above its average. So it's still more uncertainty priced in than the historical.
Awesome. That's perfect.
Okay. Any other questions?
Well, we had a question, and this was last night. I thought I may have sent it to you, but we had so much going on at the end of the episode yesterday. I may not have reminded you. This is from Ahmed, and this is the question. Nothing jumps out at me. We also have Jake on and other chameleons, but Ahmed was asking, how can we minimize the break-even point to even one strike for straddles? Can it be done by buying a very deep in the money call and points, or by selling the wings?
So how can we minimize the break-even?
It's something we really got to think about. I was telling Ahmed, if you put it in the chat, in the forum, a lot of different chameleons could look at it and drive it through. It's not something you're going to be able to screen for. It's really a question, traders should think about and get back to Ahmed on, I think. But,
I'm not sure. We'll read that question again. Let me just
again, it says, how can we minimize the break-even point to even one strike for straddles? Can it be done by buying very deep in the money calls, or by selling the wings
for straddles?
Yeah,
for straddles, you saying?
Yeah.
Let me try to think about what you mean. Like if I go to
we only have 4 minutes left.
Maybe move on to a small. I'd have to think about what he's trying to do. But
Ahmed, why don't you put that in the forum? There are lots of people, including Jake, who look at the forum Jake's on now. And, it's something that different people may have different ideas for you. So I'd put that in the forum, that question, and let the chameleon community shake it out. All right,
Yeah.
Dee, sorry about that.
No problem. Was there another question?
Well, let me see. We had a question about CLDR. I don't know if that's earnings coming up or you see anything in the options, but that was from Goat Roper, who's on every morning.
So CLDR.
Yeah.
I
think that's a relatively new issue.
Is it? Let me take a look. So,
well, Dimitri's looking at that. Everyone who is on the chat, if you're new, please subscribe to the YouTube channel. It helps the chameleon community out a lot, and you'll get alerted to any new videos. We did a new webinar last night on the long call options screener, which was full of great information from Dimitri. And make sure you give us a thumbs up, a like. That is also very helpful.
So I'm just reading really quickly about it. It's Cloudera.
Yeah.
Yes. So it's like a software company. It looks like they're using
cloud.
Some kind of machine learning.
Yeah.
I'll just take a look at the trading stats really quick here. But I mean, it does trade a lot of options, 114,000 yesterday. And on average, it trades 28,700 contracts. And just taking a look at the last month, it's looks like it's been outperforming the SPY in the last month, 2 weeks yesterday. I didn't get any, no trade ideas were filtered out, but that could be because it's relatively new, like you said. Let me just take a look. I'm not very familiar with this stock.
No worries.
So I'm just kind of like moving around, just seeing if something pops out at me. Besides, like it just traded a lot yesterday and implied volatility was up. I'd have to kind of like look through it and see if anything unusual pops up. But let me just see how the sentiment looks like so all I see is that the order flow looks bullish from the perspective of options and large block stock trades. Let me see if I have key ratios here. Actually, this is something new too that I forgot to mention. So this is probably something
you've got 30 seconds, buddy, but that's perfect.
Yeah, so I can't just looking through it. I don't know much about that stock, so there's nothing. I'll take a look at it later today, see just to find out more about it. But one thing, maybe besides that post earnings drift new feature, we are working on fundamentals, and creating like relative value fundamentals. So that's something I think we'll get into later this week as well. How to look at companies' fundamentals and start comparing them.
Awesome job, Dima. Hey, chameleons, thanks for joining us. A lot of insight. Ben, sorry, Ben, I'm not familiar with you, but thanks for recommending putting a Slack channel together. We're just trying to get this forum going right now. Everyone should try to participate in the forum. I know Jake's a big participant. There is a chat, which has been hard to move chameleons to, but chameleons always have good ideas, D, and they're very helpful. Thanks for doing this today, buddy. Great job.
Thanks, everyone. Have a great trading day. Hope to see you guys tomorrow.
All right. Stay safe out there, everyone. Have a safe trading day. Bye.